AbbVie, a prominent pharmaceutical company, encountered a mix of challenges and positive development in its financial performance in 2023 so far. The company's revenue declined by 5%, indicating a decrease in sales. However, its net income showed a substantial increase of 122% quarter over quarter, signifying a significant improvement in profitability. Additionally, the stock price experienced a decline of around 8% year to date. Today, we will take a three-step approach to thoroughly evaluate AbbVie and determine its fair value. Step 1. Margin of safety. In this step, we'll look at AbbVie's key metrics and ratios to determine if you should be more or less cautious when determining a fair value. Here we'll delve into AbbVie's financial statements and assess critical metrics and ratios. In step 3, we'll be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of AbbVie's business. By using these methods, we can determine whether the stock is currently overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of AbbVie as an investment opportunity. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we will look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. EBIT has gone up over the years, going from just over $6 billion in 2013 to just under $23 billion in 2022. The average EBIT growth during this period is 18%, which, looking at our scale, is a 5% deduction from margin of safety. The margin has gone up over the years, going from just over 32% to just under 40%. The average margin growth during this period is 4%, which is 5% deduction from margin of safety once again. The next metrics that we'll be using are the dividend growth and the payout ratio. The dividends have gone up over the years, going from just over $2 a share in 2015 to $5.92 a share in 2023. The dividend growth average during this period is 15%, which is a 10% deduction from margin of safety. This with a payout ratio that's currently sitting at 43%, which is no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. If you had a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt, and for AbbVie, this is just over 2.5 years, in this case a 256% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital is currently sitting at 12.6%, indicating that the management is very effective at allocating capital, awarding them with yet another 5% deduction in the margin of safety. Looking very good so far for AbbVie. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of AbbVie going from 2013 to 2022. The average growth rate in their annual free cash flow during this period is just over 28%, and I'm projecting their annual free cash flow to grow by 6% for the next 10 years. And with this percentage, we'll determine the future free cash flow for AbbVie and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%, giving us a sum of free cash flow of $487 billion. And to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $433 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $246.21, which is a 64.5% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of AbbVie coming from 4 years ago to the current year. The average growth rate in their annual dividends during this period has been just under 8.5%, and I'm projecting all of their future dividends to grow by 6%, and we'll once again be using a discount rate of 9% in this valuation, giving us a dividend discount model price per share of $209.17, which is just under a 40% upside from the current price. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to AbbVie, look at their stock price and their earnings per share. With this, we can determine the average PE multiple in the industry, which in this case is sitting at 27.96. All that's left to do then to get our fair value is to multiply by the earnings per share that AbbVie is generating, which is $4.25 a share, giving us a fair value of $118.81, which is a 20.59% downside out of this model. And the last model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 4.46%, while the current yield is sitting at 3.94%, indicating that it's overvalued on this metric. Doing the same with the PE ratio, on average it has been sitting at 25.47, while currently it's sitting at 35.2, indicating that it's once again overvalued on this metric, which leaves us with a downside of 19.61%. Let's go look at the final overview of valuation next. Looking at our final overview, we've imported discounted cash flow, discounted dividend, multiple valuation, and mean reversion theory price per share, giving us an average of $173.62. Margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth, margin growth, and return on invested capital, and 10% for the dividend growth, leaving us with no margin of safety at all. And then with this fair value being the same as the average out of our models, and the current price of $149.62, we get an upside of just over 16%, indicating that's a slight buy out of our valuation. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.